The Bahamas, now the epicenter of the criminal investigation of that stunning collapse of FTX crypto trading exchange. Stephen Meade, founder of thebullseyeguy.com, is on the line with us. Break down what you think brought down FTX.
FTX was a centralized crypto exchange. So what that meant is if you had your assets on the exchange, those assets, while you think they are there, actually were prey to being traded. And let's give a simple example. You put $1,000 in a bank, the bank's regulated, you see the $1,000 in your bank account. When you register and sign in, it shows you have $1,000 in your account. You technically don't have $1,000 in your account. The bank takes your $1,000 and loans it out to make money. They'll do car loans or business loans. That's how banks make money. You put money on deposit, they loan it out. But banks are highly regulated. They can't do speculative assets. They can't do speculative loans. If you think of an XTF centralized exchange, similar situation, your account balance is showing as if your money is there. Behind the scenes, it wasn't. And where FTX really made a mistake, my understanding is FTX was supposed to be one for one, its own entity. And Alameda Trading, which was the family office trade site, was supposed to be another. There was no commingling of assets. And apparently what happened was the group, I won't mention names, everybody knows them, took the deposits from FTX, moved them to Alameda, and started trading those assets.
Is it possible to even know that somebody's crypto is being traded by someone else when going to one of these exchanges?
Within a centralized exchange, there's really no way to know what's going on behind the scenes. But within your dashboard, there's no way you would know that money's gone and traded.
What do you think is the best way to regulate the digital money industry? Although there are attempts to make Bitcoin, for example, mainstream, it's rare that someone goes out and buys something with Bitcoin, but there's plenty of trading and investing in digital money.
It's a tradable asset. Someone buys crypto at 10 cents because they want it to go to $1, not because they want to buy a cup of coffee. So if we look at regulatory side, if you said, hey, if a company's going to use a token to raise capital, let's put this under the Jobs Act. There's an existing regulation. It's already there for what's called a Reg CF, a regulatory crowdfunding. You can raise up to $5 million in equity crowdfunding. There's rules, restrictions, and regulations in place using equity to raise capital. If you put a token issuance under that same regulation, you could do it. If you're trying to use crypto to raise capital, it should go under a Reg C or a type of crowdfunding. So I think the regulation is there, but the challenge is cryptocurrency is conflated where it's all glommed together as one thing.
What do you think is a quick summary of what happened at FTX?
Especially with FTX, it looks like this was just pure criminality and fraud. They took money that was on deposit in one company, moved it to another company, and traded it for different advantages. And that's what caused a lot of the issues.
Thank you for helping us out today, Stephen. Go to businessfirstam.com for where to see our show on TV.